But at the same time, if they feel like they have a higher risk tolerance and they're willing to go into these higher returns, we have written notes at higher percentages, right? So we're not opposed to looking at that on a case-by-case basis.
No, I just, personally, just like a lot of the listeners, I just appreciate the deep understanding and knowledge. They always say, if there's a mist in the leader, it's a fog for the followers. So
everybody, what's going on? Brett Swarts here with Dan Palmer. We're going to talk about the Deferred Sales Trust as it pertains to joint venture partnerships. And we're going to walk through the framework, how it works. Actually, we're going to tell a story, we're going to make a point, we're going to teach a framework, and then we're going to answer frequently asked questions. And so we'll start with the story, Dan. So we've had clients that they go, look, I really, really, really want to buy real estate. When the time makes sense for me. In fact, Warren and Catherine are a great example of this. They own multifamily properties in California for many years. And then they sold a $2.5 million property. They wanted more time and focus with their two twin daughters versus the toilets, trash, and termites. And so they were struggling with all of this, the property pulling away from the family, right? And in fact, the property actually was running well, had good property management. So it wasn't as if it was poor property management or a bunch of turnover. In fact, it was 100% occupied, great property, good location in Sacramento. It's actually in Placerville, downtown Placerville. Large 2 bedrooms, beautiful on top of the hill, right out of downtown. You can walk to downtown. It's just a really cool area. And I'll never forget them saying, Brett, we have all of this, capital and cash flow, but we don't have the time and energy that we want, this peace of mind. And so we sold the property after literally the fires almost consumed it with fire. The insurance was rapidly going up. The lucky part was the interest rates were still pretty low, so we got a good buyer and literally got a record price for that whole area. Long story short, we've diversified all this great stuff, paid off their debt, but they also want the ability to go back into their own deals because their kids are going to be 18 at some point, in 7 more years. And they want the ability to do it. So they said, Brett, how do we do a joint venture partnership if we want to use the trust to do that, to go back into our own deals? Or how do we even just increase depreciation right now, even if we don't want to do actively? And so talk to us, Dan, about what you hear there when it comes to what they're looking for. And then let's get your understanding of the joint venture partnership, and then let's work through it, okay?
Okay. So my hope is just to understand kind of the intricacies of the joint venture partner. What are the benefits to the person utilizing a joint venture partner with the trust, and what is the downside of it? And so, my understanding is, they open up an LLC, new LLC that's only going to do business with the trust, and the trust puts up 100% of the money. They GM the deal, so they're going to put all the effort and energy in. That's the partnership. And it results in an 80-20 split. Am I right on so far?
So far, yep. And there's also what's called a preferred return, right? Preferred return.
So the preferred return is going to go from who to who?
So the preferred return is going to go from the JV joint venture partnership
back into the trust.
Back into the trust, because the trust is a 20% owner, and the trust put up all of the capital, right? And the owner, the other owner in this scenario, Warren and Catherine, if it's their scenario, right? They are the 80% owner, but they didn't put any of the capital in.
Right. So the pref goes back on a monthly basis, whatever it is. We're going to try to mirror the interest rate on the promissory note, right? So it's going to get paid there, but the trust is also paying out whatever the promissory note is. Is that before or after the 80-20 split? Is that part of the expenses to where it doesn't count towards that split? How does that work?
Yeah, so good question. So the first thing I would say is it doesn't necessarily have to be monthly. In fact, most of it are going to be an annual preferred return. Although it's going to be accruing the entire year, right? So let's break this down and make it real simple. So let's say $1 million went into a partnership, and the trust puts up $1 million. And let's say the preferred return was 9%. The interest rate on the note was 9%. So you're right. We do mirror the note. So 9 and 9. So that's $90,000 per year. And fast forward, let's say the investment makes exactly $90,000 net of expenses for like a tax return or, anything that's really just general expenses for the LLC, for the partnership. and it's exactly 90,000. Then that 90,000 at the end of the year would go to the trust because the trust put up the money.
So would that come out of Warren and Catherine's pocket?
No, because the investment made that money, right?
Okay.
And so $1 million, and it made 90,000. So that went back into the trust. Now the trust, to answer your next question, is then it could pay the note holder that 90,000.
What if you do a joint, like in the joint venture partner, you're buying a piece of property, renovating it or whatever, and it's not producing a return. Right. You're making an investment because maybe 3 years down the road, it's going to double in value. The equity is building, but there's no cash flow. How does that payment go back to the trust, the prep?
So it goes when it does. It goes back in when it does. But the question is, how do we build it from the beginning, right? Start with the end in mind. So if we already knew that I needed 90,000 per year in cash flow starting immediately, then we would never go into something that's not producing 90,000 a year immediately. It basically divided by 12, right? We would say, well, that's not a good suitable fit based upon your income needs. And so the first step is determining what is your truly passive income number. Okay. And they say, well, it's 10,000 a month. You say, okay, well, how do we get 10,000 a month? Ideally net of fees, and so we might even go to the joint venture, right? We may not go to an illiquid asset or property that's not producing. Now, let's imagine they had a $5 million, trust, right? And so now 4 million can stay in other assets that are, or cash flowing 10 to 12, 14%, right? That are pouring the capital in to pay that 10,000 a month, no problem. Now the other million, we could go out into a joint venture partnership that's not going to earn maybe any cash flow for a year or 2 or 3, right?
Right.
That's totally fine. Is that making sense on that, Dan?
Totally. Yeah, that makes sense. I was just wondering about that because I know a lot of our clients are, they earned their money in real estate. And so a lot of times you're not getting a return right off the bat. It's kind of growing and building over time. So if they had to pay that pref, I was thinking it would have to come out of their pocket. But you're saying we can write that into the agreement from the beginning. It could be delayed for 3 years until the investment actually goes through a sale and they exit.
Yes. And two things on that too. Imagine it makes no money. Imagine it loses all the money. It never comes out of the client's pocket, right? And the reason is because it's not a debt. So they didn't borrow from the trust the million, personally, and then say, I want to put it to this LLC and I'm going to try to go do this thing. And like we might do from a bank. This is not a debt. In fact, it cannot be a debt. If it was a debt, it'd be a taxable event. You can't borrow from the trust to do that. So it's an investment from the trust. That's a separate entity from them that's putting that million up and it's asking for a preferred return. If it doesn't make the money, or if it only makes 7% preferred, well, then it's just 7. Now, it might even do 7% per year until year 3 or 4. And then that 2% that's been accruing that's left over will pay at the closing if that's that, or if it's there. If it's not there, then they just don't get it. It's just an investment, right? Like if we put money into a real estate property, we bought it for $1 million, we think it's worth $2 million, but it ends up only being 900,000. Well, we all lost a little bit, and then you get as much as you can back for the person who put the money in. Okay.
All right, great. So let's use easy numbers just so that we can kind of track through and under. So say there's joint venture partner, say there's 5 million in the trust. So we're not worried about the pref really. 5 million there, do a $1 million joint venture partner. So open up an LLC, trust puts up $1 million. The clients are running the deal. It goes over 3 years, it goes to 2 million. So there's $1 million gain. So it's an 80-20 split. So the clients would get 800,000 personally, and they could put it back with us, back into the trust as a second exit. So a second promissory note, but the other 200,000 would go back to the trust. What happens to that 200,000?
So 2 things I want to clarify. Remember that the preferred return is accrued. You said was it a 2-year, or what was the exit? Was it exit in 2 years or 1 year?
Let's say 2 years.
Okay, so in 2 years, right? So and it was a 9% pref. Okay, so 90,000, right? So the first thing we would say, it bought it for $1 million, right, and sold it for $2 million in exactly 2 years. Let's assume no cash flow for 2 years, right? It's just all one big lump sum. So the first thing you put 90,000 times 2, that's 180,000. Okay,
that covers it right there.
Yeah, so 180,000 would first pay the pref. Right? First pay the pref. And then what's left over would be 80-20. Okay. Then it'd be 80-20. So watch that. Okay.
10,000 left over. and it would be 80-20.
Yeah, exactly. There you go. Okay. So you got 180,000, right? So you got a million gain, right? Million gain. So now there's 820. Now of the 820,
after the prep, that was a question that I had of when that gets put in to the deal. Right. So that's actually great for the client, because then they're not losing any part of that 20%, because it's going to, that pref's going to go back, but they're getting paid a pref. Yeah. So
they're pay them anyway. So it is kind of like a debt. Yeah, it's kind of like a debt. It's kind of like a debt because it's kind of like they borrowed from the trust, because the trust owes them the 8-9% anyway. So yeah. So in other words,
about Brett, when I talk to clients, is them saying like what's happening to the other part of the upside? Am I losing?
Yeah. It? So now let's talk about that.
You say here is you're not losing. I mean, there's 10,000 left over with at an 80-20 split is going to be 2,000 and 8,000. So 8,000 is going to go to you, and that now we're only talking about 2,000. That's like a tax return.
Well, let's break it down again, just so everyone has the numbers right. So remember, $1 million was the gain, right? $1 million was the gain, and then the 9% pref for 2 years is 90,000 times 2 is 180. So I take 1 million minus 180. So now there's 820, and now I take that by 80%. That's 656 goes to the client. Which you're right. You could do a second promissory note on that if you want to, or they can just pay the tax. The 820 minus the 656 is 164. So that 164 is set to go to the trust. Okay. So two things on that, right? So are they losing that? Well, it's a 10-year promissory note, right? So every single year, that note has never stopped compounding at 9%. It's just even when it went to the JV, it's just compounding. It still owes them all that money. And we did this for 2 years, right? So this 164 will get right back into the pot of the DST for the 10-year term. So let's imagine the next year, on the third year, they had some stock losses that were down 164. Well, guess what? They're even now, right? Yeah. But let's imagine that every year we hit 9% compounding. By the way, net of fees, our fees are about 2% or so, right? So we would have to have been hitting 11% every single year, right? And let's imagine we did hit 11% every single year for 10 straight years, compounding, right? Boom, 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 boom. And there's that extra 164 left over. Yes, outside of additional planning, the trustee, that's our company, Capital Gains Tax Solutions, we would get that excess at basically at the end of that 10-year term. However, if they say, well, I just think that, I don't feel equitable, or I feel like I don't want to have to, give up that upside, right? Okay, so two things on that. Great, you can purchase an option. So backing all the way up before we went into the joint venture partnership, you can purchase an option on that excess 20%. The option's about 1.5% for a 10-year term, or 0.75% for a 5-year term. So let's walk through that. On $1 million.
Can you say those numbers again?
Yeah, 1.5% for a 10-year term. Okay. And then basically half of that for a 5-year term.
Okay, good.
So we'll do the 5-year term, okay? $7,500. They could have personally written a check to the trust to say, hey, I want an option. Should we ever have this excess? We have this big exit. Whenever we have the exit, I want to be able to carve out 90% of your 20%. So that 164, I want to be able to exercise an option, and boom, I capture that. So this is a non-refundable personal check they're writing to the trust, okay? So they're purchasing the right to carve out the upside, okay? This is what makes it legitimate and legal and equitable, okay? So it's non-refundable. It's a purchase. They give it, the $7,500 is gone, okay? And so that's gone. So that 164 now. So now fast forward, now they have purchased the option. They can get 90% of that 164. Okay, that 164. So now let's break it down. So 90% is 147,600. Okay, so that is plus the other amount, right? So now all of that can be so that's important to understand.
But that would happen before the money is dispersed, so that would go to them personally. It would connect with the other 80% they had, and then they could put that back into the trust.
You nailed it. Yeah, they could do promissory note number 2.
Yes.
Yeah, so it could be one trust, promissory number 2. So you have your first initial amount of $1 million that's been accruing, and then you got this new amount of the 147,600 plus we said the
6 something.
Yeah,
600.
656. Yeah.
Yep.
Yeah. So, so that's how it works now. So
Okay.
if you take it in bite-sized
Let me
pieces.
ask a follow-up question for
Yeah.
that, because I'm actually very concerned in this, because I get a lot of questions about it.
Yeah.
And I want it to be clear in my mind. I know that you've got it mastered, but for me,
Yeah.
I'm still like trying to work through all the nuances of it. When is there a time where it's on the negative side, where the trustee actually by law has to get some of that upside? It seems to me like the only time that could ever possibly happen is if the trust overperformed for the entire 10 years. And so, hey, who really cares? We absolutely crushed.
Exactly.
So in order for the trustee to ever realize any of that upside, as long as the promissory note is at like a reasonable interest rate, like everyone's going to be happy. Like, would you be happy if after 10 years you hit your number every single time, and then, the trustee happened to get a little bit on top of that? Like, you'd still be stoked, because the alternative is you got all the upside, but we didn't hit our numbers. We were under it. That's why the expenses ate it all up.
Yep.
And it never got to the trustee. Am I seeing that correctly?
You nailed it. Exactly right. So if all of the other investments didn't perform, it's catching that up, right? And so we've got to compound it, let's call it 11% every single year for 10 straight years, just for the possibility of making additional upside. But outside of that, so it's a possibility, but it's not very probable, right? And so the big thing is look at the big picture, right? And say, okay, the big picture is this 10-year term, which, by the way, you can renew it every 10 years for 10 years, in that scenario.
That's my next question.
Let me answer it already. I already know what you're going to ask, right? So what happens to that 164 or whatever those left over outside of the option purchase? That would still go to the trustee, but whatever else was not paid yet can be refinanced and pushed out another 10 years, right? Or 5 years or 3 years. It doesn't have to be 10, right? So you can keep kicking the can, keep kicking the can, and then your kids can step in your shoes, keep doing that as well. But yeah, you wouldn't be able to kick just because you renew for 10 years. I mean, you get to take that upside and roll it in. No, that doesn't work that way.
Okay, so explain that in detail. So I was thinking if there was some upside that the trustee was going to capture because it had done so well over the entire 10-year period, that the client could still redraw the note for an additional 10 years.
Yes, but not the upside, right? So let's imagine $1 million was owed plus another $1 million of interest, to keep it simple, right? So, and at the end of the term, there was $2.1 million net of fees. So there's an extra $100,000 there, and they're like, well, I don't want to pay tax on my $2 million right now. I want to renew it for 10 years. So you can renew that $2 million, but that $100,000 would go to the trustee, right? Because we had outperformed on that 10-year term, right?
Okay.
So you wouldn't renew the note for 2.1, you renew it for 2 million.
So I haven't been here for 10 years. So, like, how frequent is that going to happen? Like, is that an unrealistic concern that a client would have that's like rarely going to happen? Or is that something like, yeah, that's going to happen, but it's actually good for you?
I mean, the market just, in the last week was one of the worst markets we've had in years. And then today it's back up, it's feeling pretty good, this whole roller coaster of this amount. So what do we think we're going to return over any, 5 to 10 year period of time? Well, depends on your risk tolerance, depending on what asset class we're going into. It depends on how and where we invest the funds. There's so many factors here. So it's not in every single one of my clients, we're customized the investment plan, and we're getting in the market at different times. So it's literally, I don't really have the answer, except you could say the stock market somewhere between, some people say 12% on average per 10 years. Some people say 8%. Private equity, let's call it, 14% is what I've heard as well. We're doing deals at paying 16 right now, right? And we have other ones I think we're going to do on average 20% returns on these multifamily properties we're buying at a discount. We're going to double our money in about 3 years. So, I honestly, it's hard to peg it, Dan, to say this is what it's going to be for sure. But at the same time, if they feel like they have a higher risk tolerance and they're willing to go into these higher returns, we have written notes at higher percentages, right? So we're not opposed to looking at that on a case by case basis.
Yeah. Because that's the question that I normally get is, am I going to end up losing this upside? And I don't really know because I haven't got to the end of a 10-year span, and that's when it's going to, for me, when my mind thinks about it, I think if we get to the end of 10 years and we've outperformed like a yearly projection over 10 consecutive years, like there's nothing to be upset about whatsoever.
And the other thing too is you remember that 20, 30, 40, 50% of the money that's been working for you for the last 10 years is not your money.
Yeah.
It's the government's money. So when people look at the account and they're like, let's say we had a bad quarter and the market's down or something and hey, we're down. Well, yeah, you're down, but so is the government. Yeah. Like they're 30%. 40% is down as well, right? Only if we sell at this point, right? So you have to realize that people forget. They think it's like, oh, all of this is my money. No, maybe 70% is. The other 30% is not. And the government, by the way, is charging a 0% interest rate.
Yeah, which is amazing.
And then the next question comes, well, what happens if we lose it all, which we haven't and not likely. But the government still, you don't own any tax. If it goes to zero, you don't own any tax. So it isn't like you still owe the tax. So people get that confused too. They're like, well, do I still owe it if it doesn't work out? No. If it all goes to zero, you go zero. I'm going to zero. We've never gone to zero, right? We diversify. We go into great investments. But yeah, these are the things that I think people have to work through because the biggest challenge is that I think the mistake people make is they're so used to having unilateral control and all of the upside, 100%. We're rugged individualists. We're all Americans. These are entrepreneurs. These are very successful people. And we're used to like, I don't want to give an inch, right? Oh, okay. Well, then you could pay the tax up front and give, 20, 30, 40, 50 inches, if you will, right, of tax. And then go have 100% of 60 or 70%. And they go, oh, okay, you're right. But the other part of this compounding effect is also the income tax. This is more most people miss. Instead of just looking at the top of the layer here, which is the cap gains tax deferred or the upside, what you can and cannot get on the 80-20 or the 98-2 with the option, is actually looking at the month by month or the year by year income tax. This is the one that's mostly missed, meaning you might have a note for $5 million and let's make it at 10%. Okay. So it's $500,000 a year. You may take $41,000 a month in interest payments, but you also may only take $20,000 a month, allowing that other 21 to compound and build up. Okay. And by the way, that is something you can refinance in the 10-year. You hadn't been paid yet, right? And so if you actually break it down again, and you say, what's my truly passive income number? And let's just say it's $30,000 a month, Dan, right? And you go, okay, I'm going to take 30 months, the other 11,000 just accrue. Well, that's huge because for the next 10 years, guess what? There's no income tax on that 11,000 that's just accruing. And then fast forward 10 years, you do that again, and you might even turn it down. You might say, well, my kids are out of the house. I don't need 30,000. I only need, 18,000. Now you have a bigger chunk that's accruing every single year. And so you've really got to look at the compounding effect of the income tax deferral, not just the capital gains tax and not just the upside. The last thing I'll say here on this is you have to realize if we joint venture partner with the trust, there's a brand new depreciation schedule of which you can capture about 80% of that on a year-to-year basis. So this is huge, right? Because if I sold in Bitcoin, or if I sold a real estate that had zero basis or a business, I have no basis, which means I have no tax flow depreciation to offset my cash flow. This is really important. So I sell, and let's even say I take $2 million and I buy a $4 million apartment complex. Well, that $4 million apartment complex that I leverage, which you can do, I can get the depreciation of that myself through the joint venture partnership. That's huge. I went from a zero depreciation to a fresh 80% on a $4 million depreciation schedule. And so this is how we make the DST an investment and not an expense. And so you just got to keep going deeper with us here, right? And not let the first layer ROI or the first layer number or even let this thing be like that's the mistake, right? Instead, switch your mindset to tax flow, cash flow, debt flow, and the ability to compound the tax deferral with an income tax. And then ultimately use the Deferred Sales Trust on our team to help you execute this. You don't have to do this on your own. This is why we're here. We love it. So any last words for anyone, Dan, before we jump?
No, I just, personally, just like a lot of the listeners, I just appreciate the deep understanding and knowledge. They always say, if there's a mist in the leader, it's a fog for the followers. So, I know I got my understanding's a little misty. So when I try to explain it, it's going to be a fog for them. So the clearer it gets for me, the better it is for the people that I'm talking to. So I appreciate the deep wisdom.
Anyone, thanks, Dan. That's great. And if anyone wants to take action, you can go to capitalgainstaxsolutions.com. You can schedule a one-on-one time with myself and or Dan or one of my team members who will walk you through all of this where you're no cost, no obligation. If you have $1 million net proceeds, $1 million gain. Second, we have webinars happening all the time where you can come on and you can see this visually broken down and you can ask the questions. Okay. So whether you're a CPA, a financial advisor, a commercial real estate operator, broker, anybody, luxury real estate agent, you want to know how to do this and we want to teach you. So you spend some time with us. So go to capitalgainstaxsolutions.com to get on our email list, to get invited to the webinars. And then also check us out some live events. We're going to lots of live events to speak and such. So appreciate everyone listening and watching out there. And one more thing. If you wanted to get the book too, we got a book we wrote on this called Building a Capital Gains Tax Exit Plan. And you can check that on Amazon. Appreciate everyone out there, and we'll talk to you all real soon. Bye now.